Well, as we turn the page to March, it's time for the market update. We'll get Bill's thoughts on what's happening in terms of inflation. Plus, should we become accustomed to mortgage rates that are a little bit higher? That's coming up next. Hello and welcome in. Glad to have you on the YouTube channel or on the podcast, wherever you listen. We appreciate it. Hit subscribe wherever you are, and we will continue to grow and put out more content and try to keep you updated on what's happening around the mortgage world and the real estate world with Bill Litton, as always, at Cross Country Mortgage. Bill, what's going on?
Hey, Ben. How you doing?
Things are good. Things are good. Turning the page towards spring. I know this is typically a busier time, right, for real estate as we turn the page to March.
Yeah, I think that every year the spring market really ramps up, and a lot more people, at least in the Northeast where we are, because I think of weather patterns. I think they have a lot to do with it. So as the weather starts to break, and that's the prime selling season for your home, we see a lot more homes come on the market, which actually is going to be really helpful because right now the inventory is very low, and it's we're right back to that many offers, multiple offers, way more buyers than sellers, and it's kind of brutal right now.
Is it? What is I know I've seen rates tick up a little bit, I think, recently. What are the inflation numbers showing us, and kind of what are you keeping your eye on right now?
Yeah, so inflation, the last two readings came back a little bit hotter than what the Fed had forecasted, right? So, and the market, it kind of is in line with the forecast, and then when the forecast is exceeded and the inflation numbers are higher, then the market adjusts. So when that happened, the past couple of weeks, we've actually seen rates ticking up a bit. Now, it's never a linear drop from the 8.5% that we had in October down to wherever we're going. But, we on January 1st were roughly at 6.25%. So we came from 8.5% in October to 6.25% in January of 2024. Now we're up closer to 7%. So we've clicked back up a bit. But we do feel like as the year progresses, inflation will continue to cool, and that will help interest rates as the year goes on.
Well, I'm curious to get your thoughts. I was looking at some news recently and saw that the Bank of America CEO was on, I think, CNBC, just normal visit, I think, talking about the economy, inflation, interest rates, that sort of thing. And one comment that he made that I thought was interesting is that he said that people should maybe start getting used to rates being in the 6 or 7% for mortgages. So I know I won't get into all the specifics on the reasoning for it and how he kind of broke down the economy and spending and consumer and everything else, job market and whatever else. But the bottom line is that he said that maybe this is kind of what we should expect, at least for the near future, next few years for sure. So what I was curious about was if that is the case, which, might not be surprising. Again, if you look over the long term, this 6%, 7% still is a low mortgage rate. Should people start getting ahead of potentially everyone else getting used to this rate? Because when they do, I feel like everybody will return to the market again. You'll start seeing the competition once more. And it seems to me like if some of the experts think rates will kind of stay where they are, getting back in now ahead of the competition where there's not as many people battling over the same homes like there will be when people decide, hey, I can just eat the 6% and we'll move on with that. Should people be more aggressive now, I guess, before we become more accustomed to the 6%?
Yeah, so I think this is a really great question because I hear a lot of people saying we're going to wait until the rates come down. And when the rates come down, that's when we're going to buy. So rates have been, higher since COVID for about 1.5 years, okay, maybe a little bit longer. Since that 1.5 years increase in rates has, affected the market, home values have continued to climb at faster than normal paces around the country. A little bit different depending on where you are, but so if you're waiting for the rates to get better, you've lost out on that equity that you would have gained, right? the trend is going to continue because we still have a shortage of housing. So supply and demand says if the supply is low and the demand is high, it's going to continue to increase the values. It's going to continue to push values higher. So if you're waiting for rates to come to a range of 4%, that might not happen for a long time. And based on what Bank of America is forecasting, and maybe that's not their economist forecast, but maybe that's what the CEO thinks. Either way, it's a really good point because interest rates, although we do believe they're going to come down in the next 12 to 24 months, the big question is, what are they going to come down to? And we think they're probably going to end up in the low 5 area. So getting used to rates in this range is, I think, healthy, with the idea that if you can stomach, right now we're over 6.5, if you can stomach that for 12 to 24 months, then at the end of that period or sometime in between, you're going to get down into the low 5s. But don't wait thinking you're going to get to the low 4s, because we don't see that on the horizon until maybe a little bit further out. And that's also depending on some other geopolitical issues. I mean, that's just if the Fed keeps doing what they're doing and there's no more wars or any more global crises that would affect that. And then, like economists a lot of times are, they get beat up a little bit because their forecast isn't accurate, but that forecast can't take into consideration an invasion of Israel or an invasion of the Ukraine, right? So these things add different variables to the formula. So I think leaving those things out, I think that there's a lot to be said for get used to where things are now. There's probably going to be a refi opportunity, but don't go buy $1 million house expecting you're going to refinance to 3% and hold out for that, because that would not be smart.
Because am I wrong in thinking that once people do get used to 6 or 7% and let's say in a year from now, more and more people, now would be almost 3 years removed from 4s, right? So more people are going to say, okay, 6%, it is what it is. I'm going to go out and go ahead and secure that new home. The prices and the values could potentially go up if there's more demand, right? So you might be waiting to hold out and might get a slightly better percentage, but you might also end up paying a little bit more as more people come into the market looking for a home, right?
So we actually believe that one of two things is going to happen. Either as rates go down, I think more buyers are going to enter the market, right? There also could be a situation, though, where more sellers enter the market. So you actually could have a situation where the supply and demand is a little more even, because there's a lot of sellers on the sideline saying, I'm not selling because I'm at 3%. But maybe if I could get a 5% rate instead of 7%, I would make the move to the new house. Now, that's just a prediction, Ben. We really don't know. So to your point, if you're waiting for rates to hit 4.5%, it's probably not wise, because A, we don't know when it's going to happen. B, we know the values are going to continue to increase. And C, as you just mentioned, there's a good chance it could be a crazier market. There could be a lot more buyers in the pool, and that could be driving prices up at a faster clip. So, again, I think a lot of this revolves around if you're in an area that you think you're going to be in for a long time and you have stable employment and you're renting, you're really just throwing your money away compared to owning, probably not a good reason to wait. The news headlines will scare you. When we look at everything and we do the analysis and look at the math and look at the appreciation, and we also look at the amortization of paying the loan down and any tax advantages, plus the peace of mind and the pride of ownership, very strong case for buying now.
Well, if you have questions, you want to follow up, sit down and kind of see what your mortgage options might be, the best place to start is by calling 484-352-4151 or log on smartmortgageshow.com. You can take advantage of a free 15-minute mortgage and loan consultation with Bill Litton over at Cross Country Mortgage and see what that might look like. But we'll keep you up to date on the market as we move forward. A new month will bring new updates, and we'll talk to you then. This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.